Hey everyone, and welcome to today's Explainer. We are diving into the global financial market data for the first week of August 2026, and let me tell you, this was an absolute roller coaster. I'm talking about extreme, literally unprecedented volatility that completely threw the usual trading playbook right out the window. We're going to break down exactly what went down, look at the hard data, and most importantly, figure out what this all actually means for you.
Okay, we've got to start right here with this number, negative 23,000 jobs. In July of 2026, the U.S. economy unexpectedly lost 23,000 jobs. To really put that into perspective, economists were confidently predicting we'd add 86,000 jobs. So, yeah, this was a massive, undeniable miss, a total black swan event in the non-farm payrolls data that caught Wall Street completely off guard.
But here is where things get super weird. Normally, a disastrous labor report like that would send the markets into an absolute tailspin. But instead, the market threw a party. It literally feasted on this terrible economic news. So we really have to ask ourselves, why? Why on earth did a terrifying signal about the American workforce trigger an absolute buying frenzy on the trading floor?
Well, here's how we're going to decode this chaotic week. We'll start with the NFP job shock, then explore the market paradox. Take a look at the full asset picture, check in on currency and crypto, and finally, lock in our investment strategy for next week. All right, let's jump straight into part one, the NFP job shock, a true black swan event.
Moving right along to part two, the market paradox, or as I like to call it, the return of bad news is good news.
So initially when this jobs data dropped, it triggered instant panic selling. People were terrified of a sudden recession. But you know what? That panic evaporated in the blink of an eye, transforming into pure market euphoria. Why? Because investors suddenly realized that a strikingly weak labor report basically guarantees aggressive rate cuts from the Fed. So bad economic news magically became good news for stocks. Over the course of the week, those rate cut hopes acted like rocket fuel. The S&P 500 surged an astonishing 3.6% to hit a brand new all-time high, and the tech-heavy NASDAQ, it absolutely exploded, gaining 6.1%. The sheer prospect of easy money just completely overshadowed the reality of a struggling workforce.
Okay, part three, the full asset picture. Let's look at the scorecard.
Looking at the data from the Friday close on August 7th, we see a really fascinating divergence. Now, we just talked about the massive 3.6% weekly surge for the S&P, and the Dow also managed a bump of over 0.5%. But look a bit further down the board. Gold shot up 3.3%, while the US dollar index, the DXY, took a major hit, dropping over 0.5%. And Bitcoin? Well, it was actually kind of muted by comparison, up just under 2%. What we're seeing here is capital moving in very specific, highly strategic directions in response to this macroeconomic earthquake.
For gold, it was honestly the perfect storm. The economic weakness from that jobs report drove a huge wave of demand for defensive, safe haven assets. And at the exact same time, those aggressive rate cut expectations weakened the US dollar, which essentially lowers the opportunity cost of holding a non-yielding asset like gold. This incredible 1-2 punch rocketed gold to a staggering record high of $4,342 per ounce, just a flawless textbook fundamental breakout.
Which brings us to part four, currency and crypto, diverging paths.
So while gold was thriving as the ultimate safe haven, the US dollar ended up being the biggest victim of the week. The DXY violently collapsed down to 99.60, breaking right below that critical 100 psychological level. I mean, capital was aggressively fleeing the greenback. With the market pricing in significant Fed rate cuts, the future yield on the US dollar simply looked way less attractive to global investors, which triggered a massive sell-off.
Now, surprisingly, Bitcoin was entirely out of rhythm with this broader risk-on party. While the NASDAQ was up over 6% and gold was shattering record highs, Bitcoin just couldn't break through its heavy $67,000 resistance level. It ended up spending most of the week hovering around $65K. And honestly, this tells us something super important about the current market psychology. During this specific shock, institutional money clearly preferred the comfort of traditional tech stocks and tangible gold over the crypto market. All right, finally, part five, next week's investment strategy. Let's get into some actionable steps.
Now that we've decoded the absolute chaos across all these asset classes, how do we actually position ourselves for the upcoming trading week of August 10th through the 14th? Well, first, we have to understand the market's current emotional state. The fear and greed index dial is pointing firmly to greed at a level of 64. We're rolling into the week with cash flow in a state of extreme euphoria, all based on these expectations for monetary easing. But, and this is a big but, this sentiment carries massive hidden risks. If inflation suddenly rebounds and takes those rate cuts off the table, this greedy sentiment is going to vanish in a flash.
So here is your direct actionable strategy based on the data. Number one, do not chase overextended stocks. With the market this euphoric, we should definitely expect a strong pullback or some heavy profit taking in the S&P 500 and the Dow early in the week. Number two, the macro trend for gold is still incredibly robust. That old resistance at $4,300 has now become a hard support floor. So be on the lookout to buy gold on dips as it tests that new $4,300 level. And number three, keep a really close eye on the dollar index. It is heavily oversold right now, so watch for a potential technical bounce around that 99.00 mark. Which brings us to our final thought for today. As we ride this incredible wave of market euphoria, you need to keep one vital question in the back of your mind. Will returning inflation crash the market's rate cut party? Because let me tell you, if the macroeconomic data turns and inflation rears its ugly head again, this entire bad news is good news narrative could literally collapse overnight. So stay vigilant, stick to the data, and thank you so much for joining me for today's Explainer.